All right, let's just get right into this. Welcome to today's explainer. I'm going to step into the role of your practical older brother today. Because look, we really need to have a serious talk about something that is quietly costing you money. When you buy stocks, you are buying a piece of an actual living business. But if you're like most people, the moment a company releases its annual report, that massive, deeply intimidating 300-page corporate brick of a document, you probably download it, look at that crazy page count, get completely overwhelmed, and immediately close the PDF. Well, not anymore. Today, I am going to completely demystify this document for you. By the end of this explainer, you're going to be speed reading these reports like an absolute pro.
Because here's a question for you. Why do 99% of retail investors end up losing money in the stock market? It's a really painful reality, but the answer is brutally simple. They are flying completely blind. Almost no retail investors actually read annual reports, none of them. They buy stocks based on some hot tip or what's trending on social media or just a random gut feeling. And by doing that, they leave themselves completely in the dark regarding the actual health of the companies they are pouring their hard-earned money into.
But here is your solution. The annual report is the absolute, undisputed truth document. Period. In India, SEBI, our market regulator, literally mandates that every single listed company must put this document out into the public domain. Usually they drop the previous financial year's report around June or July. So if you're looking right now, you'd be digging into the 2023-24 annual report. And guys, this isn't some glossy marketing brochure. This is where the actual truth lives. We're talking profits, losses, debt, management's actual unfiltered thinking, their future plans, and most importantly, the hidden risks. The whole shebang is in there if you just know where to look.
So here's our master map for extracting that truth. We'll hit the letters from management, the director's report, dive deep into the MD&A, check the auditors and notes, review corporate governance, and wrap up with a 30-minute speed read framework. Let's jump right in.
Step 1 on our map, letters from management. This is where we figure out if we're getting honest talk or if we're just staring at a hype machine.
The very first page you should always turn to is the chairman's or CEO's letter to shareholders. You've got to evaluate their tone here. A personal note from the boss reveals whether the management is shooting straight with you or if they're just trying to sell you a dream. I mean, Warren Buffett's letters for Berkshire Hathaway are world famous precisely because he writes so honestly about his own mistakes. In the Indian context, a perfect example of this is HDFC Bank. If you read the letters from their former CEO Aditya Puri or their current CEO Shashidhar Jagdishan, you'll immediately notice a highly factual, grounded tone. They straight up tell you what worked, what didn't work, and what they learned from it. If you open a letter and it is just a non-stop chest-thumping celebration with absolutely zero mistakes acknowledged, yeah, that is your very first major red flag.
Moving on to step 2, the director's report. This is where we strip away the fluff and find the actual operational reality.
Now, this is a formal report put together by the board of directors. And honestly, a lot of it is just dense legal boilerplate. Just ignore the fluff. Instead, treat this section like a checklist. You want to zero in on the operational highlights and major events of the year. Check the dividend declared. How much cash are they actually paying out, and what's their logic for it? You also need to look at their subsidiary companies, because sometimes a parent company looks amazing on paper, but a hidden subsidiary is quietly bleeding cash in the background. Finally, hunt for the segment breakdowns. In HDFC Bank's director's report, for example, they don't just hand you one massive useless revenue number. They break it all down into retail banking, wholesale banking, and treasury. That shows you exactly which engines of the business are actually doing the heavy lifting.
All right, step 3, the MD&A deep dive. Pay attention, because these are literally the most important pages in the entire document.
Listen to me carefully here. The management discussion and analysis, the MD&A, is the absolute core of the annual report. Ask any professional analyst. This is their bread and butter. When you're reading these 10 to 15 pages, you are actively trying to contrast empty corporate jargon with real data-driven transparency. Are they just spitting marketing fluff at you? Stuff like, we aim to be the best in class and leverage our synergies. That means literally nothing. Or are they giving you a data-driven reality check? Do they take their competitors seriously? Do they explicitly acknowledge specific market risks? Going back to HDFC Bank's MD&A, you won't just find vague feel-good goals. You get granular hard details on their credit costs, their non-performing asset or NPA trends, their deposit growth, and exactly how they are planning to navigate new regulatory changes. Remember, data is the ultimate truth teller.
Step 4 brings us to auditors and hidden notes. It's time for the ultimate reality check.
Whatever you do, do not skip the auditor's report. I repeat, skipping this is a massive, costly mistake. Look, management can say literally whatever they want, but external auditors, your big firms like Deloitte, EY, or BSR, they actually have to audit the company's books and officially state on the record whether the financials are legit. You need to understand the 3 types of opinions an auditor can give. First up is an unqualified opinion. Despite sounding like a bad thing, this actually means clean. The financials are correct and you are good to go. Second is a qualified opinion. This means there are some doubts or exceptions. Consider this a bright yellow flag you definitely need to investigate further. Third is an adverse opinion. This means the financials are fundamentally wrong or misrepresented. This is a screaming red flag and your only action is to run away as fast as you can. Oh, and a quick pro tip, if a company is constantly changing its auditor every single year, yeah, that is a massive warning sign that they are desperately trying to hide something.
Right after that auditor's opinion, you're going to hit the notes to accounts. Now, I know it's usually 50 to, actually, scratch that. It can easily be 100 pages of agonizingly dense text. But guess what? This is exactly where corporate scams hide. You don't have to read every single word, but you must check a few key areas. Are they being super aggressive in their revenue recognition policy? Like, are they booking revenue before they actually even get paid? How fast do they depreciate their assets? Look at contingent liabilities. Are there massive hidden court cases going on that could literally bankrupt them? Check for subsequent events, which is basically any major drama that happened right after the balance sheet date. And definitely keep your eyes peeled for key audit matters, which is where the auditors explicitly point out the most sensitive financial areas they had to heavily scrutinize. But out of all those dense notes, I need you to isolate the biggest, most toxic danger of them all: related party transactions. Listen, if the promoters of a public company are doing business deals with their own private, hidden entities, they can easily just fix the prices. It's a backdoor way to siphon money straight out of the public company and right into their own private pockets. This is literally ground zero for corporate fraud. So if you're reading the notes and you see a tangled, confusing web of related party transactions that just don't make any logical business sense, do yourself a favor and step away from the stock.
Step 5. Corporate governance. This is where we look for the ultimate warning signs about who is actually running the ship.
Because frankly, even a great business can be utterly destroyed by bad governance. You need to memorize these warning signs. If more than 50% of the promoter's stake is pledged as collateral for loans, that indicates extreme financial stress. If independent directors, the people who are legally meant to protect you, the retail investor, if they're suddenly resigning out of nowhere without clear reasons, there is smoke in the building, my friend. Frequent changes to the chief financial officer, massive accounting issues are probably brewing. And if the board members or the audit committee aren't even bothering to show up to the meetings, well, how on earth can you trust them with your money? Ignoring these signs is exactly how investors get wiped out completely.
And to really ground this danger in reality, just look at recent history in the Indian markets. Yes Bank, ILNFS, Monpasand Beverages. Thousands and thousands of retail investors lost their shirts when these companies collapsed. But you want to know the most tragic part? The clues weren't hidden in some secret underground vault. The governance red flags, the weird aggressive accounting, the auditor warnings, they were all sitting right there in plain sight, published in their annual reports, months and sometimes years before the final collapse even happened.
Which brings us to step 6, the big payoff, the 30-minute speed read framework.
Okay, we have covered a ton of ground here. And you might be sitting there thinking, this is great, man, but I don't have 3 hours to spend reading one PDF. Totally fair. So here is your 30-minute clock to completely demystify a 300-page document. Step 1, spend 5 minutes fully reading the chairman's letter to get a real feel for their tone and strategy. Step 2, invest your biggest chunk of time, 10 solid minutes, entirely on the MD&A to hunt down those risks and data-driven points. Step 3, take 5 minutes to scan the director's report, looking specifically for the operations section and their dividend logic. Step 4, spend 3 quick minutes confirming the auditor's opinion is clean and scanning those key audit matters. Step 5, allocate 5 minutes to jump into the notes, specifically hunting for those shady related party transactions. And finally, step 6, spend your last 2 minutes checking the corporate governance section just to make sure the promoter pledge isn't dangerously high.
80. That is the magic number to remember here. If you use this 30-minute framework, you are going to extract 80% of the critical information you need to make a smart, informed investment choice. You absolutely do not need to read every single legal disclaimer. You just need to follow the map we laid out today to find the actual truth.
So I'm going to leave you with a bit of a challenge. Think of a stock you currently own, any stock. Go to their investor relations page right now, grab that PDF, and set your timer for exactly 30 minutes. Prove to yourself just how powerful this framework really is. And once you've mastered navigating the report, you'll be totally ready for our next explainer, where we're going to strip away all the financial jargon from balance sheets, P&Ls, and cash flow statements. Until then, ask yourself, are you going to keep investing blind, or are you finally ready to uncover the truth?